Okay, so recording has started. Let me share my screen. Just like I said when we ended yesterday's class, today we are going to be starting company income tax. And it is one of the most important topics. All the topics that we've been taking previously is to prepare us for this particular topic. We want to prepare ourselves on how to take a company income tax question. Okay, without further ado, let's go into the class. So now, for company income tax, we need to classify companies. And before we can go into what companies are currently classified into by the new tax law, we need to know the previous one. Because in the pack, what we have is the previous one. Nonetheless, I'm going to be talking about both. So let's just cross our hands to see the question that will come out, whether it is going to be according to. I don't expect it to be according to the new tax act because I don't think they're going to test it until the next diet. But according to Finance Act 2019, we have three classifications of companies. We have small companies, we have medium companies, and we have large companies. Now, small companies are companies with a gross turnover of 25 million. Where you have below 25 million or 25 million. When you say less than or equal to, that's the word. Less than or equal to 25 million turnover. And when we're talking about turnover, that's revenue or sales. Revenue sales. So any company that has, that's why you see some questions that they'll tell you that the company's revenue is above 25 million. They are trying to tell you that the company is not a small company, right? So for this small company, their tax rate is 0%. You need to that the tax rate is 0%. That is, they're exempted for paying CIT. CIT is company income tax, but they must have registered for tax purpose. They must file their tax return on or before the due date, and they must comply with all other provisions stipulated under the Company Income Tax Act. So though they're not paying anything monetarily, but they must file their returns, because if they don't file their returns, how will the tax authority know that truly this company is earning below 25 million? It's like a proof of transaction. So, but for medium companies, these are companies whose turnover are greater than 25 million but less than 100 million. Greater than 25 million but less than 100 million. Those are your companies, and their tax rate is 20%. Their tax rate is 20%. But for large, who is that, please? Oh, there's somebody that has unmuted this or mic. Stanley, thank you for muting yourself. So everybody should mute their mic so we can enjoy this lecture. We have quite a long way to go. Okay, so I was talking about medium companies. They are, let me use a mathematical term, greater than 25 million but less than 100 million. Greater than 25 million but less than 100 million. But for large companies, we have greater than 100 million. As long as their turnover is above 100 million, you are considered to be a large company. And your tax rate is going to be what? 30%. I hope we're good. So now this is like what I think you guys would need for your exam. This particular one that I just discussed for you. Because number one, that's what's in the pack. Number two, the new tax law is not yet is not examinable yet. Yeah. But just in case I decide to put in like what the new tax law says, because I don't trust ICANN, honestly. I don't trust it. So, but the new tax act has changed the classification of companies into just two. We have small companies with turnover below 100 million or fixed assets below 25 million. Sorry, 250 million, not 25. Turnover below 100 million, fixed assets below 250 million. The above conditions still stand and they are still tax exempt. So what I mean by the above conditions still stand is that they are still going to be paying 0% tax, but they still have to file their returns. They still have to comply with other what tax legislation but they're not paying any money. And the second one is the large company. As long as your turnover is above 100 million and your fixed assets are above 250 million, you are a large company. There's nothing like medium company anymore. We have just small and large companies now, and the tax rate for large companies is going to be 30%. I hope we're good. Now, determination of assessable profits. Just like we discussed in Module 1, accounting profit is not directly used to compute tax payable. It has to be converted into a tax profit, right? We know that as adjusted profit. That adjusted profit will consider the tax law, exempt incomes, allowable and disallowable expenses. So we have a simple illustration of how we arrive at our taxable profit or adjusted profit here. So, like, the first thing you have to do is to write your company's name. These are mundane things, or should I say simple and normal things that we might overlook, but it's very important. In ICANN, half mark is important, 1 mark is important, and these things carry those things, those 1 mark, half mark that can turn your 49 into 50 is very important, right? So, company name is important. Write the company's name. Then computation of adjusted profit for the year ended this. All right. So now, if you notice what they wrote here, for the year ended is an accounting date, and they wrote into bracket assessment year 2025. I would advise you to write computation of adjusted profit for 2025 year of assessment. But sometimes the student might not be sure of the year of assessment he or she is computing for, which is very strange. But I tell you, sometimes I kid you, you might be confused. If you're not sure of the year of assessment, please don't put the year of assessment. You can just write for the relevant year of assessment. Relevant year of assessment might turn your 1 mark to half mark, but it's better than nothing. If you write the wrong year, it's like you don't even know what you're doing. Because I don't even if I'm the person that will mark you, I will definitely mark you down. Do you get? So if you're not sure about the year of assessment that you are computing for, please don't put any year. Just write relevant year of what? Of assessment. I hope you got that hint right. Okay, so now we're going to be starting from net profit per account. That is the net profit that we have in our financial statement. Usually profit before tax. Okay, so then we have deduct non-taxable income. There are some income that cannot be taxed. So you deduct them, so we don't have to tax them. Like the reason why we're deducting them is because we cannot tax them, right? Add back disallowable expenses. Those expenses that you have removed from your profit that is not allowed in the tax frame, you have to add them back, right? Then you have your adjusted what profit. This is just like a simple illustration. Company income tax refers to tax payable on the profit of a company accruing derived from bought into or received in Nigeria. Right. So we are just telling you that CIT is tax payable on the profit of a company. When you say profit of a company, sometimes when you say accruing in Nigeria, the profit is accrued like you earn that profit in Nigeria. You might have derived the profit in Nigeria. You might have like gotten the profit elsewhere, then brought it into Nigeria. Nonetheless, we tax everything, right? So a company shall be chargeable to CIT in its own name, in the name of the principal officer, attorney, factor, representative, or in the name of a liquidator. What we're trying to tell you is that even if it is not the company itself, yeah, it doesn't mean you're not going to pay company income tax, right? So it could be, let's say, principal officer example can be like a director of the firm. They know the director is running the company for you, so they can charge in the name of the director of so company comes as on the director. Okay, the company will sharp pay nonetheless. I guess all these ones are not so. Now, what is a company? What is a company? A company, any company or a corporation established by or under any law in force in Nigeria or elsewhere. Established by or under any law in Nigeria or elsewhere. This means that CIT is payable not only on the nationwide income of a Nigerian company, that is a company incorporated in Nigeria, but also on the profits of a foreign company, that is company incorporated under any law in force in any territory or country or outside Nigeria to the extent that such profit derived from Nigeria. I know it sounds like English. Let's break it down. So number one, you should know that a Nigerian company is any company that is incorporated in Nigeria. The word incorporation means registered. You have registered your company in Nigeria. That makes that company a Nigerian company. Now, a Nigerian company is not the only company that pays tax. And you should know that just because you're a Nigerian company doesn't mean you not pay tax on other on profit that you make in other countries. For example, a Nigerian company might have made profit from Ghana, from UK. You will pay tax on those profits too because you're a Nigerian company. They're like branches or subsidiaries. You pay tax on them. And now it's not just Nigeria company that now pay the CIT. We're telling you that a company that is not registered in Nigeria can pay CIT if their profit, let me try to highlight it here. If their profit is derived or is deemed to have been derived from what? Nigeria. So we have some things that govern that particular um word, but we are going to get there. So we should just know that Nigerian company pays tax, non-Nigerian company pays tax. Now, the profits, okay, there are some sections that have been amended by the Finance Act 2021, and it said that the profit of a company other than a Nigerian company from any trade or business shall be deemed to be derived from Nigeria or taxable in Nigeria where. So now we are, no, I already told you that it is not only Nigerian company that pays CIT. Non-Nigerian company can pay CIT. So we're not telling you that if you're a non-Nigerian company, you operate a trade or business and want to tax you, like these are like the, should I say, reason or the circumstances where a non-Nigerian company would have to pay tax. A non-Nigerian company would have to pay company income tax. I hope I'm making sense. If you have any question, you can just put it in the chat box or raise up your hand. Okay, so wow. Number one, the company has a fixed base of business in Nigeria to the extent that profit is attributable to that fixed base. This one is telling you that the word fixed base is also known as permanent establishment. Let me take a realistic example here. Let's say Kelvin is a UK citizen, but let's say Kelvin visited Nigeria and they're like, oh my god, there are a lot of people that need let me see, that loves ice cream in Nigeria. You know, those all those cold ice cream, that all those corona ice cream that they used to sell for us that we no longer used to buy. And it's not that, oh, if people saw a very good like ice cream that they can buy and it's tasty and it's not so costly like all those, Cold Stone. He saw a market and decided to tap in. Then he has a shop where he sells the ice cream. The funny thing is he might just leave somebody there and go back abroad. But the thing is that he has a shop. There's a permanent establishment. Sometimes it might not even be a shop. Could be, let's say, somebody that came to open an accounting firm in Nigeria. There's a fixed space. We can point at your office. It could be a store, and they are making profits from that particular location. Then we have to tax your profits there. Even though you are not in Nigeria, you might have registered the company in your in your own country or not in Nigeria. The thing is, you are making profits from our people, and you have to pay tax on it. So number two is it does not have a fixed base, but operates a business through a person in Nigeria authorized to conduct on its behalf or on behalf of some company controlled by it, or have a controlling interest, or maintain a stock of goods or merchandise in Nigeria from deliveries that are regularly made by a person on behalf of the company. This one is just saying that you don't have a fixed base, you don't have a shop, but you operate through somebody in Nigeria. Somebody is helping you to operate your business in Nigeria. Let's say sometimes this could be like all these virtual or hybrid roles. Virtual hybrid roles, you don't have a shop, you don't have a store, but you can do all this China importing stuff, right? You are the one that sells abroad. People in Nigeria buy from you. You have somebody in Nigeria that will help you to collect all the goods that these people need and help you to distribute them. You guys don't have a shop, you don't have a store, but the person is conducting on your behalf, selling on your behalf. or on behalf of a company that you control, or the person help you to keep stock. Like I said, the person is collecting your goods for you and distributing it for you. That means you are still what? You are still earning profit in Nigeria, and you have to pay tax on that particular what? Profit. Where it transmits or receives signals, sound messages, data of any kind, cable, electronic magnet, the English is too big for my teeth, or any other electronic or wireless apparatus to Nigeria in any respect of activity to the extent that the company has significant economic presence in Nigeria and profit can be attributable to such activity. A very good example of this is like all this radio station. Let's say, for example, Fresh FM. I don't know if everybody knows Fresh FM. Fresh FM is in Nigeria, but people abroad can listen to Fresh FM. So now let's say reverse is the case. Assuming Fresh FM is a London company, but we in Nigeria we can listen to Fresh FM. My dear, you will pay tax on the money that you're going to get from us because from us listening to you, it means that Nigerian company can actually advertise on that particular radio station. Do you get? So companies can have profit through those transmission of messages. Oh, a very good example is Facebook. What am I saying? Facebook, Twitter, Instagram. The owners of these things, are they in Nigeria? Is this a Nigerian company? Are they not making money from us? People are running mad ads on Instagram, on TikTok, but they are not Nigerian companies. So this company has what is called significant economic presence. This word is more of significance to professional guys, but it's just like the word significance implies, which means that like you are I'm trying to look for a word that can describe what SEP means. So significant economic presence is just that your presence in the country is noticeable. It is noticeable. They are yardstick or threshold that are used to measure whether a company has SCP or not. But that's not where we are going, right? So that trade or business involves a single contract for supply, delivery, installation, construction. Um, I don't know why I don't know what I omitted from this particular stuff. The profit from that contract. Oh, so what I'm trying to say that you have it's not like you have a shop or anything or you transport anything, but you got a contract in Nigeria, whether you want to survey, you want to deliver something, you want to install something, you want to construct something, all those Indians that will come and build something here that they will bring them from their place and they will come and build it here. Is a contract of supply and they're going to get profit from that and they are going to pay tax on it. Then trade of business comprises of furnishing technical management consultancy or professional services outside of Nigeria to a person resident in Nigeria to the extent that the company has significant economic presence in Nigeria. Now, before we move to the like what the other part of the E is saying, that part is saying that you are not a Nigerian company, but you are offering technical, management, or consultancy or professional services to somebody in Nigeria to the extent that you have a significant economic presence in Nigeria. Just like we have all these PwC, EY, all these big five, we also have them outside of Nigeria. And if they have a company that they render service to in Nigeria such that it gives them SCP, then they have to pay tax on whatever profit that they get from attending to those companies. So provided that withholding tax applicable to the income under this paragraph shall be the final tax on the income of a non-resident recipient who does not fall under the description of A to D above. So if a company does not fall under any of these things that we have mentioned, and of course you came into Nigeria or you got profit from Nigeria, the final tax under your profit is going to be withholding tax, which means no CIT, no company income tax. When we get to withholding tax, you are going to understand that one better. But what we're saying that there are some profits earned by non-residents of Nigeria, people that are not living in Nigeria, that is what subjected to withholding tax only. Withholding tax is the final tax on such income. Okay. So now income. Taxable income are those in respect of the following. Number one, these are income that we can tax. income that are liable to what? Taxation. When you have them, the government will tax them. Number one, the any trade or business for whatever period of time such business may have been carried on. So these are profits that you get from your trade or business, your like primary what's it called? Primary business activity. Yeah, that's the word. Primary business activity. So rent or premium arising from a right granted to other person for use or occupation of property. So if you collect rent from your tenants, it's an income and it's taxable. Premium, there's something called royalty. Okay, it's even number three safe. So those things are like when you grant another person the right to use your assets, for example, land for a particular period of time. Whatever your royalty you collect is taxable. Dividend, interest, discounts, charges are not taxable. Any source of annual profit or gain that does not fall under this one, two, three that we have mentioned before is taxable. Do you get? So now the purpose of this is to ensure that no taxable profit escape the tax net of the board. Fees, dues, and allowances for services. What we are saying is, if it does not fall under one, two, three, it is still taxable because we don't want somebody to say because it does not fall under one, it does not fall under business activity, it does not fall under rent, it does not fall under dividend interest, income. I not pay tax. No, number four has covered every other thing that we did not mention from one to three. But on taxable income, income that cannot be taxed. Number one is interest on foreign loan granted after April 1st, 1978. How many of us have they giving birth to in 1978? I don't understand. So interest on foreign loan is not taxable. Interest on foreign loan is not taxable. Interest on any loan granted by any bank on or after January 1st, 1997 to a company engaged in number one, primary agricultural production, local fabrication of any plants, providing working capital for any cottage industry established by FIP. So this one is just like incentive to these companies that we have mentioned. So if a particular company and you do all of these things, if you borrow money from bank, the interest is not going to like be taxed. Um, the interest you get is not going to be taxed. Interest on loan granted by bank for the purpose of manufacturing goods for export. Everything is interest. Tax exempt income. These are the income that cannot be taxed. This one is almost the same thing as non-taxable income. But profit of any company being a a statutory or friendly society, in so far as such profits are not derived from trade or business carried by such society. So these ones are friendly or statutory society. And I'm trying to think of examples of such society. I don't know. I think all this Rotary Club. I don't know if you know Rotary Club should fall under this one. So what the caveat that in this number one is that this club sometimes they have businesses that they run. As long as the income is not from the business, it is exempted from tax. Let's say, for example, subscription of that particular club is exempted because, but if the club has supermarket and supermarket is getting income, right? So that one is not exempted. Supermarket will pay tax. So then the profit of any company being a cooperative society registered under the enactment or law relating to cooperative society. So cooperative societies are not expected to pay tax, but you have to register as a cooperative society. And it's not like you have, some cooperative society have shops, they have businesses. Those ones will pay you. We're talking about income relating to that cooperative society. Profit of any company engaged in celestial or charitable activities. This one, I think this is where you need fall under all these churches, mosques, they're not this charitable organization. Profit of any company formed for the purpose of promoting sports. This one is there. Then trade unions too. Dividend distributed by trust units. This place I wrote read more because it's very plenty. I should have written the page that it is on the I've forgotten. You just write the page. It's very plenty. You just pick the one that is easy for you to cram it because it can come out and cram it right. I just wrote a little and now allowable expenses. These are the expenses that are allowed by tax authority that you can remove from the profit. Sorry, I'm not even checking if you guys have a question. Is there any question? I don't think so. There's nothing in the chat box, right? Okay. So allowable expenses, unless otherwise provided, I'm putting this for a reason. Unless otherwise provided, because allowable expenses sometimes there are some expenses that are sometimes normally allowable, but because of the condition of the question that you are solving, would become disallowed. So that's why this word is very important, unless otherwise provided. For the purpose of ascertaining chargeable profit or loss of any company from any source, only expenses that are rarely incurred in the production of profit shall be allowable as deduction for tax purposes. Remember, rarely is what? Wholly, reasonably, exclusively necessary. Wholly, I don't write it accordingly, sorry. Wholly, reasonably, exclusively, and necessarily. That means you are saying that rent, it has to be because of the business. The reason why you spend that money is because of the business. It's not for personal purpose. It's not for any other thing that does not have to do with the business. That's mainly. So now they now give us example. Number one, any sum by way of interest on debt borrowed or employed as capital in acquiring the profit of the company. So you borrow money because you need capital for the business. And of course, there's cost of debt now. When you borrow money, you have to pay interest. That interest is allowable because it is the business. Don't if you borrow money for yourself, you borrow money, you use it to buy car for yourself. It's not for the business. So you're not expected to remove the interest on such money from what from your expenses because it's not for the business. Wilfred, your hand is up.
Yes, well, good evening, ma.
Good evening.
Yes, I want to ask whether this tax does it mean is it that this new tax law is it going to take effect on this diet, or are we not to consider it this new tax law?
According to ICANN's rule, it's not supposed to take effect this time because they said that it is 6 months after implementation, according to them. But I've seen in the past
Okay,
question where they ask a particular question and it has to do with the new law that just came out at that particular time. And when I saw the answer, it says in there that the students are expected to familiarize themselves with new laws. Do you get that? It has gone against that principle, right? That's why I always
okay.
bring the new law to
Because
you.
you say
Not
something
students
here
for
that
new classes.
okay, because I see the allowable expenses here in the new tax law that necessarily the reasonable.
I can no longer hear you. I think his network is off because I can no longer hear you. But if you can hear me, um, I just I want you guys to know any laws, whether new or
The
old. That's why I
so
put everything.
yes, I can hear it now.
Okay, okay. So the new laws are supposed to take effect in the next diet, not your diet. But like I said, I don't trust ICANN. That's why I'm teaching you everything. So if it should come out, you guys will know what to do. Okay.
All right, thank you.
Um, you're welcome. So we have rent and premium paid by the company in respect of land and building used for the purpose of generating profits. So rent and premium. Now there's a caveat to this, and it says that a building occupied by the company's employee as residential accommodation. Now, when a particular company pays rent, sorry for the noise, please. When a particular company pays rent for their employee, now the rent or premium paid by the company is restricted to 100% of the basic salary of such employee. So this is very important. If the company is paying the director's house rent and director is collecting 1.5 million, house rent is 2 million per year, what will you do? You restrict the house rent to 1.5 million, which is the exact basic salary of the director. This information is very important. Do you get? So next one is salaries and wages or benefit in kind granted by company to senior staff and executive. Benefit in kind include what we have spoken about: rent, premium, or it could be maybe they gave the man car. Those things are allowable as long as it's for what the business. Is somebody raising up their hand? Um, Yakubu, your
Yes,
hand is up.
ma'am. Madam, ma'am.
Okay.
Please help me share more light in regards to the director's salary and the rent in which the company pay for the salary. A little bit, please.
Okay. You want me to shed more light?
Yes, 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 yes.
It's actually um self-explanatory. So what we are saying is that some companies actually give
Please
apartments to
share
their
back your screen with us. The
okay,
material.
there it is. So the company sometimes pay the rent or even just give them apartments. So if, for example, you work as director for Andron Homes, Andron Homes is a real estate company, right? They will tell you that okay, because of your position, oh, you have an apartment in, let's say, Lekki, right? Sometimes the house is their own, they own the place. Sometimes they rent it and just give it to you for free. So the amount of rent that they pay for that particular apartment might be more than the best person's salary. If it is more than the salary, you restrict it to the person's salary. The rent must not be more than 100% of the person's salary. The person that is living in that house, it must not be more than 100%. If it's more than 100%, you restrict it to the what? 100%. If the rent is 5 million, the person that is living in the house, the salary is 3 million. You remove only 3 million for rent and not 5 million. The remaining 2 million is gone. Are we good?
Yes, ma'am.
So, all right, thank you. Repairs and renewals in respect of plant premises, or that is all this fixed assets, as long as those things are used to what? To acquire profit. Bad debts.
Yeah. Yeah, I know. Hmm?
Sorry for that. Sorry. Okay. So bad debts incurred in the course of trade or business. Bad debt incurred. Now, you must ensure that the debt is actually bad. Remember, they said that it must have been proved to become bad, but during the period and specific provisions for doubtful debt. Now, this one is emboldened because it's very important. Because in your question, you have general provision and you have specific provision. General provision for bad debt is disallowed. Specific provision is allowed. Bad debt incurred is an allowable expenses. Specific provision for doubtful debt is an allowable expenses. General provision for doubtful debt is disallowable. Please note that. R&D expenses for the period is what? Allowable. Now, any profit from trade or business. In the case of profit from trade or business, any expenses part of, let me read this and try to explain. The liability for which was incurred in that period for the purpose of trade or business, which is not specifically referable to any. Okay. So now this one is saying that you incur a particular liability. It is not for other period. Definitely is for this period. You are going to what? Recognize that liability. Then you incur in another period. For example, you incurred liability last year but that liability is for this year. So it is this year expenses that you are going to remove it from. Expenses prove towards the service that has been incurred by the company on R&D. We have talked about this before. Deduction as prescribed by the minister. Dividend or mandatory contribution made by real estate to its shareholders. This one is right. Sorry. Now, compensating payments that qualify as interest. Compensating payments that qualify as interest to an approved agent. Donation is allowable based on certain conditions. Donations is allowable based on certain conditions. So what are the conditions? Number one, it must have been made to fund or bodies or institution contained in the fifth schedule to SITA. This fifth schedule, I have it, and I honestly don't know how I did it. I don't know what I used to save it. I've been looking for it, but I'll surely get it and add it to the drive because you guys need to go through it. You cannot cram it because it's plenty, like 3 pages, but just go through it, and when you go through it, you'll find it familiar. Then that's number one. It must be made to what bodies approved in the fifth schedule. So number two, it must be made out of profits. What we are saying is that you cannot make a loss and you are saying that you are donating. Or you made the profit of 500 million, you donate 500 million, you donated 1 billion. So you have to make donation when you have profits, not when you have loss. And your donation must not turn your profit into loss. Then number three, donation must not be in capital nature. You cannot donate building, abimoto. You cannot donate it, except if you are donating to a university or other tertiary or research institution. Those are the three people that can donate capital nature things. When I say capital, you know what we mean, assets. Those are the three people that you can donate it to. Then it must not exceed 10% of the company's total profits for an assessment year before you even deduct the donation, right? But in case of a research institution or tertiary education or tertiary institution, it can be up to 15% of the total profit or 25% of tax payable in the year, whichever is higher. You know that we already said that capital expenditure is allowable to research institution and to tertiary institution. So because of that, capital expenditure requires more money. That's why when it comes to these people, it can be 15% of total profit or 25% of tax payable, whichever is higher. But for other people, it must not exceed 10% of total profit. Then donation made by companies in cash or kind. When I say kind, that means other things. It can be like other things except for cash. Yeah. So to any fund set up by the government or state government, designed by federal government to any similar fund. God, what are they saying? In respect of any pandemic, natural disaster, or other exigency shall be allowed as deduction as follows. The cost of in-kind donation made to the government shall be allowed as deduction. So now there's a natural disaster, like for example, COVID, Lassa fever, and what was this? Ebola, and those things. Now you made a donation. What are the conditions that will make your donation an allowable expenses? Number one, donation that you make in kind to the government or any of the designated agency will be allowed. The cost, if it's in kind now, the cost, for example, during COVID, you now decide to empower people because people lost their business a lot. So then you decide say a government office to take computers. So the cost of the computer will be allowable deduction as what donation. Then if the company has manufactured something for that particular donation, the cost of the purchase, the cost of manufacture or supply shall be what allowable. I guess we are good here. Now R&D expenditure, it must not exceed 10% of total profits. We have established the fact that R&D is an allowable expenses. So we're not saying that R&D must not exceed 10% of the company's profit for the year before even deducting the reserve or the provision. Now, companies and other organizations engaged in research and development activity for commercialization shall be allowed 20% investment tax credit on their qualifying expenditure for that purpose. This one is under capital allowance. So we are saying that R&D people, people that like their work, their business is research and development, they'll give them 20% tax credit. Now, disallowable expense. What are the expenses that you are not allowed to what? To deduct? Number one, we have capital repaid, withdrawn, or any expenditure of capital nature. This is very important. So you borrow money from bank. Eh? We're not talking about interest here. We're talking about the principal amount, the principal payment. You borrow 5 million. Please mute your mic. Whoever that is, mute your mic, please.
Lady ọmọlọ́mọ yẹn ló tún kọ́ wa o.
Who is that person? My comfort, please mute your mic. Thank you. Okay. So now capital repaid. So we're talking about you borrowing money from the bank. You borrowed 5 million from the bank. You have paid interest. Interest is an allowable expense because it's for the business that you have borrowed money for. But the repayment of that 5 million is not an allowable expense because it's a capital payment now. It's capital in nature. You cannot remove that kind of money. Or you bought let me say motor. Like you have a bakery business and you need a car to help you like go and deliver your bread to supermarkets where you sell your bread. That car that you bought is capital expenditure. You cannot deduct it from your expenses now. Is an asset that is supposed to be in your financial statements, not an expenses. Do you get? So anything that you're supposed to classify as assets is not supposed to be an expenses. Those things will go to assets and will suffer capital allowance. I mean, will enjoy capital allowance. They are not expenses, right? So some recoverable under insurance contract or a contract of indemnity. A sum, for example, you lost a particular good, you lost, or you have a bad debt. But even though bad debt is an allowable expenses, you already have insurance contract that will help you to repay the debt. No, there are insurance contracts that when you lose a particular amount from your customer or your goods got stolen, they will what? They will the insurance company will what indemnify you. That particular expenses you will not be able to remove it for tax purposes because they believe that the insurance company will still give you back. If the insurance company will give you back, why are you removing it? That's it. Then taxes on income or profits, except the one levied outside of Nigeria, which are also taxable in Nigeria. In respect of which double tax rate is not available. Let me explain this. What we are saying is that if we tax you, for example, this is 2026. Tax of last year, you now come and remove it from your expenses this year. You don't do that. You don't do that. Your tax is not supposed to be an expenses. Do you get? So now, except there's a caveat, except that tax was levied outside Nigeria on profits that is also taxable in Nigeria. Then there's something called double taxation arrangement. It's a professional topic. So you guys will not get to do it until you are a professional. Double tax arrangement is when a particular profit will be charged to tax in more than one country. You are going Nigeria will tax it, another country will tax it. Example of company that might be in such a dilemma is Facebook. Facebook is not a Nigerian company, but will pay tax for Nigeria because it is earning profits, significant economic presence in Nigeria. But remember that Facebook is in another country, and the country too will collect tax. So now, if there is no double taxation relief between Mark Zuckerberg country and Nigeria, it means that Mark Zuckerberg will be paying tax in two places. In that case, the tax that Mark Zuckerberg has paid in other places outside Nigeria is an allowable expenses. I hope we got that. Depreciation is disallowed. Depreciation pata is disallowed. It is replaced by what? Capital allowance. Any expenses incurred outside Nigeria or within Nigeria that involves related parties to the extent that it is consistent with transfer pricing regulation. Now, this one is trying to tell us that you have incurred an expenses. I need to explain what related party is. You guys are already doing CR now. You know, parent and subsidiary, associates. These people are related parties. So it's like something that know each other. You guys are not transacting between one another. Is used to there's something that we call base erosion and profit shifting, BEPS, where companies, especially related party, will start to they will be shifting money among themselves to reduce their tax liability. That is why we have this law. If you have any expenses that you spend to a related party, it's not allowable deduction, because it's like I'm passing money from my elder sister to me, I mean from me to my younger sister. Is it not this? Is it not inside the same pocket that everything is going? So that's like the basic explanation for number 5. So now any expenses incurred in deriving tax exempt income, losses of capital nature, or any expenses are liable under capital gain tax. So now, if you use the expenses to do tax exempt income, we are not taxing the income, but that means we cannot allow the expenses to. Losses of capital nature is not supposed to be moved, because when you anything capital nature is has to do with assets. Anything assets, don't bring it here. Any expenses are liable under CGT. We are still going to do CGT. Oh, sorry, we are not doing CGT, it's for the professional. So any expenses that is allowable under CGT is disallowable here, and the same thing under CGT, CGT too. CGT too. If it's allowable under CGT, it's not allowable here. If it's allowable here, it's not allowable under CGT. That's how it is. So any compensating payment made by a borrower that qualifies as what? Dividend. Compensating payment. So dividend is not an allowable expense. Penalty or fine. Penalty or fine is not allowed. If you go and call you last man, you go and eat last man on the road. Abi your employee went to cross the road and last man carry the person. You are not going to allow you to remove the fine. Abi your driver went to go and violate one rule, and they now fine you. Abi you did not pay your tax on time, you chop penalty. All those money are not an allowable expenses though. They are the one that did not follow rule. And once you did not follow the rule and you pay fine for that, like violation of rule, is not going to be allowed as an expenses for you. Any tax or penalty borne by the company on behalf of another person. So the company is paying tax for somebody else. However, your new expenses is not possible. It is not possible. So penalty that is not for the company, but the company is the one paying for the person. You cannot remove it. It's not allowed. So yes, I hope we are good. Before we move to restriction of interest, of deductibility in interest, please, are we good? Any question? I know this thing is boring now, but please try to, if you understand what I'm saying now, by the time we move to calculation, it's going to be easy for you to, like, to go ahead with me. Kindly give me a couple of minutes. Let me.
Can we go ahead, man?
Oh, sorry, I thought I muted myself. Sorry. I went to take water. I thought I muted myself. Okay. Restrictions on the deductibility of interest. Now, let me start from here. Interest deductible by a Nigerian company or a fixed base of foreign company in Nigeria in respect of debt issued by a foreign connected person to 30% of EBITDA of the Nigerian company in that accounting period. Please let me explain this thing. So we are saying that if, let's say for example, a company here in Nigeria has a parent company abroad or a subsidiary abroad, the person now borrow the company money. No, you are going to pay interest on the money. But we're not saying that this law restricts the amount of interest that you're going to pay to 30% of EBITDA. They've tested this before. Even me, I fell trap of it, I tell you. They tested it. So, though it was a professional question, but like I said, don't trust I can. Read everything they want, know everything knowable, right? So if they come from anywhere, right, left, center, anywhere, you'll be able to grasp well. So let me say this again. A connected person, the person is connected, which means that it's either the parent or subsidiary or an associate. Isha somebody connected to the what company, right? A company connected to the company. And this is because of tax planning. Like I said, BEPS, base erosion and profit shifting. That's what brought this thing forth. Companies would intentionally borrow themselves money so that the other company will be paying high interest and thereby moving profits from high tax paying regime to low tax paying regime. So because of that, they decided to restrict the amount of interest that can go outside Nigeria. So if you borrow Nigerian company money and you think you can use interest to carry their profits outside of Nigeria, they decide to say, okay, you think you are smart, you're not smart. We restrict that interest to 30% of them. If it's more than 30% of their EBITDA, then it is disallowed. Even if they paid the interest, it is a disallowed expense. So if the interest is, let's say, 40% of their EBITDA, then the remaining 10% disallowed. You only allow 30%. Just like we restrict capital allowance, this one too is a restriction. If the interest that they pay to that company is more than 30% of EBITDA, you disallow. And the thing with this is that they will not give you the EBITDA. Most of the time, they will not give you the EBITDA. You really want to calculate it because according to accounting, should I say structure, we have the profits and the income or revenue, less cost of goods sold, you get your gross profit, less expenses, you get net profits. Then sometimes you have net profit or earnings before interest and tax. Then you remove your finance cost, you get earnings before tax. You remove your tax, you get earnings after tax. So what you now do is to work back that earnings after tax, add back your tax, add back your interest, add back your depreciation, add back any amortization, if any. Those that will not form your EBITDA. Then you now do 30% of that EBITDA. You compare it with the interest. Is it more? Is it less? If it's more, you use the interest. If it's less, you use the 30% of EBITDA. I hope we are good. So now, a Nigerian subsidiary of a foreign company engaged in banking or insurance is excluded from this rule. So if the company is engaged in banking or insurance business and the subsidiary is in Nigeria, it is what exempted for this rule. But it applies if the what Nigerian company is parent to a subsidiary that is outside. So please, this thing, that rule. If the Nigerian company is the subsidiary is the one that is Nigeria, parent is outside Nigeria, parent now borrow subsidiary money, then don't restrict their interest. But if the parent is in Nigeria, subsidiary is outside Nigeria, subsidiary borrow parent money, restrict the interest to 30%. I hope we are good. Let's move. The remaining
Well,
interest,
again.
is somebody speaking?
Yes, I said, could you please explain the EBITDA? What is it?
EBITDA.
The one you
Earnings,
just finished, the
earnings
30%.
before interest,
Yes.
tax,
Yes.
depreciation, and amortization. I'm saying that for you to get that particular figure, you are going to take your earnings after tax, you add back your taxation, you add back your finance cost. Finance cost is the same thing as interest. You add back your depreciation and you add back your amortization, if any. Those things are expenses. You add them back to get your EBITDA. Then you now do 30% of the EBITDA. If the interest is more than 30%, you are picking the EBITDA. If the you are picking 30% of the EBITDA, sorry. If the 30% is higher, then you're picking the what? The interest. I hope we are good.
Yes, ma. Thank you.
Okay. So the remaining interest shall be carried forward for a maximum of 5 years, immediately succeeding the assessment year for which the excess interest expenditure was computed. So we are telling you that you can carry the remaining interest forward though. That one that you disallow, that the one that is above 30% that you disallowed can be carried forward for 5 years only, counting from the what? The assessment year. If, for example, is in this assessment year, this 2026 assessment year, that you disallow their interest, so you count your 5 years from 2027, 2028, 2029, 2030, and after 2030, any interest remaining cannot be carried forward again. You stop it. Do you get? But then I believe within 5 years you have to have completed the interest. So a penalty of 10% and interest at CBN monetary policy rate plus a spread to be determined by the minister or any adjustments made by the service relating to excess interest charge in a year is payable by the person that violates the provision of this rule. Okay. So it means that if you not follow what they said, you are paying 10% of the money plus the interest at CBN monetary policy rate plus anything that the minister said that you should pay. Everything. That's the penalty if you refuse to follow the interest law. So we have ways of computing company income tax. I think is it 4 or 3 ways? Minimum tax, normal basis, dividend. We have three. We have 3 ways of computing. It's four, sorry. It's 4 ways. 4 ways of computing company income tax. This is the normal basis. This is what you guys will be doing mostly. Right. So let's look at the format together. I hope everybody is with me. This format, if you have access to the drive, you don't need to write it. It will be on the drive. I'll upload it. If you don't have access to the drive, please start writing and that. Okay. I beg you, in the name of God. So now, company income tax as ascertainment of total profit. This one's supposed to be enter like, how can I say it? I I also have written it better. Ascertainment of company income tax for particular year of assessment. Okay, so we start with profit per account. Here we are talking about our net profit. You bring your net profit here to the second naira. Then you add back all disallowed items that are not allowable, which have been deducted in your account. You add them back. For example, depreciation. Then this one, capital expenses on shares. Any preliminary expenses. When I say preliminary expenses, I mean expenses that you incur in incorporating the business or before incorporating the business is not allowable. It's not an allowable expenses, please. For example, you want to do IPO for the company. When you just like you want to fund to a company, those expenses are not allowable. Capital expenses disallowed, rent disallowed. Remember, rent above 100% of salary is what disallowed. Donations that does not comply with the conditions listed disallowed. General provision for bad debts disallowed. Diminution in value of investments. This one, there's something that we call notional expenses. For example, depreciation is a notional expenses. Please, ladies and gentlemen, notional expenses are expenses that does not leave the bank of the business. Like, let me take depreciation for example. Depreciation is these expenses that we are removing in our book, but it's not going away from our bank. Abi, do we use to remove depreciation from the bank? Do we use to pay depreciation in cash? Who are we paying to? Nobody. It's a notional expenses. Notional expenses, notional income, those things are not taxable because it's like you're building castle in the air. You're not collecting any money. So that is example of diminution in value of investment. It means that your investment are reduced in value until you sell the investment, and that when you even sell the investment, what you are going to pay on it is CGT and not CIT. So if your investment now lower in value, don't come and remove the expense abi the loss here. Don't come and remove it here. Gain on the sales of investment is not taxable here. It's taxable under capital gains tax. So you're not taxing it here. So that's the same to profit on sales of property is not taxable here because number one, when you sell your property or asset, it's taxable under capital gain tax, not company income tax, right? Number two, when your assets increase in price and there's fair value gain, fair value loss, those things are not allowable. Fair value gain, fair value loss, those fair value things, they are notional. I hope we get it. So these are the little examples of allowable expenses. Then less what? Profit on sales of property. We less this one because we cannot tax it. Plant and equipment profit on export sales. This one, I think I've made a mistake in writing this thing. Maybe, okay, PPE, property, plant and equipment. Profit on sales of property, plant and equipment, you less it. Profit on export sales is, this one is like an incentive. Like, I did not really get much information about it, because I know that all sales is supposed to be what's taxed. So non-taxable income now include interest on agri or export loans. That is if the company is an agricultural company. So now if you now put all the balances together, you got your accessible profits. Now you less loss relief if you have any loss. Then you have your what? Your balance again. You had your balancing charge. If you have balancing charge, remember, balancing charge is under capital allowance and balancing charge is taxable income. Less capital allowance. That's if you have any capital allowance. All your capital allowances, this is what are the those initial annual allowance. You will have added it together. Whether it's initial, it's annual. You would have added it together. Then balancing allowance, if any, you also less it there. Restrict your capital allowance to 66 to over what? 3% of accessible profits. Restrict it. If this restriction is what is lower, you go with the restriction and then you have capital allowance carry forward. After removing your capital allowance, then you have your what? Taxable profits or total profits. Taxable profits or total profits. Company income tax is payable using the rates, applicable rates. When the reason why they wrote applicable rate is because we have medium company that use 20%. We have large company that use 30% based on the 2019 Finance Act. But if you are looking at the new rule, it's just 30%, right? But let us look at 2019 because that's our focus. So we are hoping the new rule is not examinable yet. Then you pay tertiary education tax 3%. This tertiary education tax, it has come out because you have to look at the year of your question to know the rate of TET to use. You have to look at the year. Which year does the question fall into? I would like to, I thought I included the thing in my notes, but it seems I did not include it. So I'll just say it here. Maybe after the class, I will edit the document or put it on the platform. I only wrote it in my book, sorry, when I was making the text. So now, let me put it in the comment section for everybody to have access to it. So we're talking about TET. Wilfred, please a second. Let me write this TET out. Tertiary education tax. So you use 2% for years before January 1, 2022. When I say January 1, 2022, I'm talking about accounting period. That will be like which year of assessment? This is going to be 2022 year of assessment, right? So it means that if you have December 2021, you use 2% TET rate, right? But you use 2.5% for periods or years between, I should not write this in there, for years between, what am I writing nonsense, right? For years between January 1, 2022 to September 1, 2023. I hope we are good. So we have to be careful of the dates. You have to cram it up. 3% will be used for years after September 1, 2023. So let me write it in a different way. 3% will be used from September 1, 2023 till date. I think that's better. So that's for tertiary education tax, so TET. That's for TET. So Wilfred, your question.
Please go back to the material. Yes, my question is that please can you explain more on this restriction to 66 to over 3% of accessible profit?
Yeah, we discussed it when we were doing capital allowance. We actually discussed it, but then I would repeat it. I just was not expecting that question because I think it's something we already know. Okay, so we are saying that your capital allowance for the year must not pass 66 to over 3% of accessible profits. If it does, then you restrict it to that particular amount and carry forward the remaining capital allowance to the next year of assessment. Did you get it? So you are going to be doing, is either you write 66 to over 3% or you just write 2 over 3 straight. Don't put percentage behind it. 2 over 3 is 2 over 3 multiplied by your accessible profits. Whatever figure that it give you, you compare it with your total capital allowance. If the capital allowance is higher, you restrict. If the restriction is higher, you absorb your total capital allowance. I hope I'm making sense. Wilfred, are you good now? Or you still don't understand it?
Yes, I understand it now. I understand it.
All right, thank you. So, company income tax is not supposed to be paid by small companies, same thing as tertiary education tax. They don't pay, it's not supposed. But you know that in the new tax law, all these tax, tertiary education tax, what's it called? Police fund, everything has been embedded into development levy, which is 4%. 4%. Everything has been embedded into that one. We're not going to be dealing with it here because for now it does not concern us. So that's the normal basis. Normal basis. Now let's move to the second one. We have talked about first type. The second way of calculating company income tax is called the minimum tax basis. Now, this minimum tax is not for everybody. There are some companies that you use this basis for because the normal basis is what we discussed before. That is why it's called normal basis. As long as you are not abnormal, your company is not abnormal, that is the basis that will apply to you, right? But if you are now moving to the abnormal realm, then other bases will start applying. Now, according to this minimum tax basis, gross turnover is defined as the what gross inflow of economic benefits arising from the operation of activities such as the sales of goods, supply of service, lending of money, letting of assets, granting of rights, etc., etc. Now, gross turnover for the purpose of minimum tax includes all operating income or revenue anywhere embedded. Now, the following companies are specifically exempted by Finance Act 2019 from paying minimum tax. Number one, a company that earns turnover of less than 25 million in the year of assessment, which is a small company. But remember that a small company is now what? 100 million. So if you are a small company, you don't even get to pay minimum tax at all. A company carrying on agricultural trade or business does not have to pay minimum tax. A company that has not been in business for more than 4 calendar years of its commencement of business. Now, this number 3 affects number 1. How? Listen to this carefully. A small company is a company that just started business, right? That's why it's still small. It has not yet grown and started making big sales. Now, if a small company has been in business for 4 years, for 4 calendar years, and it's still a small company, it did not graduate to a medium or large company, that small company will start to pay minimum tax. Please, did you grasp what I said? Let me repeat myself. A small company that has been in business for 4 years, for 4 calendar years, and is still a small company, did not move to being a medium or large company, that company will start to pay what? Minimum tax, right? Minimum tax. Now, frank investment income, we need to know the meaning of. We have not talked about how to get minimum tax. So all these things that we are defining and beginning is going to help us to, to understand the computation of minimum tax. So now, frank investment income is dividend received by one company from another company after deduction of withholding tax. So before that company receives the dividend from the other company that is paying the dividend, they have removed withholding tax from the dividend, which means they received net dividend and not what? And not gross dividend. Such dividend is known as what? Frank investment income. Please, you have to note that. Now let's move. Any dividend received without deducting withholding tax will not be deducted from gross turnover in the computation of minimum tax. So now what we are saying is that if they did not remove withholding tax before paying you the dividend, it does not qualify as a frank investment income. It does not qualify as a frank investment income. Please, are we good? If they did not remove withholding tax from a dividend before paying you, that dividend does not qualify as a frank investment income. Now, before you can now say that your dividend is a frank investment income, you must have evidence that they have deducted withholding tax at source before you treat your dividend as a frank investment income. Number 2, frank investment income, when you did not add it to your gross turnover, then don't remove it from your gross turnover when you are computing minimum tax. So now, what is minimum tax? Minimum tax is 0.5% of gross turnover less frank investment income. 0.5% of gross turnover less frank investment income. That's why I'm saying that everything that we are defining is to what allow us to understand what minimum tax is. We now know what frank investment income is, but note that you have to ensure that your dividend is a frank investment income before you remove it from your gross turnover. And if they did not even add dividend to your gross turnover before, don't remove what they did not add you. It's not there. So why are you removing it? I hope you guys understand that. So if it is not added to gross turnover initially, don't remove it. If it does not qualify as a frank investment income, that is, if they did not remove the withholding tax before paying you the dividend, then don't remove it. Now, based on Finance Act 2021, minimum tax is equal to 0.25% of turnover less frank investment income. But this 0.25 is not the new minimum tax. So it's only for what? For a particular period of time. We have January 1, 2019 to December 31st, 2021. See, within this period, we have three assessment years. Who is that? Oh, who is that? Oh, Tiwan Choshi. Mute your mic. Thank you. Okay. So between these three periods, January 2019 to December 2019, January 2020 to December 2022, January 2021 to December 2021, three. We have three periods here. A company will choose two out of the three periods, and within that two, and for that 2 years that the company has chosen, they will apply this 0.25% instead of 0.5%. This one, if you notice the dates, is all these COVID-19 dates. So it's just like to help companies to relieve them of the effect of COVID-19. So, and I don't even think they will give us questions that will go back like this. But in case they give you question, please note the dates. Note the dates. You can write it in your notes that you have applied 0.25 because it falls into this period, and you wish to help your clients to take advantage of the incentive. Somebody is raising up. Oh, Victor, you can speak.
Sorry to drag you back, but please, can you go back to the format for the normal way? I got lost at that add balance charge. Please.
Formats. I'm coming now. For how come you are just talking about that? This place.
Yes, from here. And the next
So,
one.
is it that you don't understand?
No. I was not able to write down the format from there. You're a bit fast.
Oh, sorry. Have you written it now?
Yes, I've gotten this part, the next part now. Okay, thank you.
You're welcome. I'm going to pay
Thank
for your
you.
material. Go and pay for your material and stop stressing yourself. Pay and print it out. Stress is not good for you. That's why we are stressing on your behalf. Okay. So now I think we are good with minimum tax. Minimum tax, this is minimum tax here. I ought to bold in it. I don't know why I forgot to bold in it. Let me put it in highlights. Pink. I like pink. Yeah. Minimum tax is 0.5% of gross turnover less franked investment income. 0.5% of gross turnover less franked investment income. Please, you have to memorize that. You have to memorize that because, okay, let's move. We have some conditions that will warrant a company to pay minimum tax. In what condition would you know that, oh, this company is supposed to pay what? Minimum tax. That should be the next thing. I did not put it here. No. Did I omit it? Wow. I'm surprised though. Okay. So we pay minimum tax. I'm surprised that I can't find it here. We pay minimum tax, number one. We have it here. If the company has been in business for more than 4 years, 4 calendar years, the company is expected to pay minimum tax. Whether the company is still small company or is big company, we are going to pay minimum tax. Let me check if I can find this thing here. Then for a company that their taxable tax payable is lower than minimum tax, will pay minimum tax. Let me repeat myself. Your minimum tax is 5 million. Your actual tax payable is, I just don't know the page that I'll go to now. Your actual tax payable is, let's say, 4 million. It's 5 million that you will pay. You are not expected to pay below your minimum tax. You are not expected to pay below your minimum tax. Please, let me try to see if I can locate.
I cannot hear you, ma.
I'm not speaking actually. I'm trying to look for the conditions for minimum tax for you. No, they not put it in the pack. That's why. There are conditions though. Please give me a minute. Let me I have them somewhere. So let me try to, because if I should stop this class, I might not remember to go back to it. All right, guys. So it's just what we have there actually. So the thing is, if yes, it's being recorded. I'm recording the class. So what we're trying to say here is that a company will pay the higher of a head. A company, let me write it out. A company would pay the higher of the minimum tax or the actual tax payable. So if your minimum tax is higher than the actual tax that you are supposed to pay, you are paying your minimum tax. If your actual tax is higher than your minimum tax, you are paying your what? Actual tax. Please, did we get that? That's what I was looking for. Supposed to be like specified, but I guess it was not. Okay. Now let's go back. Okay, so now that's for the minimum tax basis. So the third one is gross turnover basis. Now it's saying that FIRS now has the discretionary power to assess and charge a company to tax on a fair and reasonable percentage of the turnover of that particular company or the particular trade or the particular business. And they have the power they have the right to exercise this power in the what? In the following circumstance. Where a company does not have any accessible profit, the tax authority can say, oh, you guys don't have accessible profit. Okay, no problem. Come and pay 2% of your revenue. Come and pay 5% of your revenue. Number two, where the accessible profits, in the opinion of FIRS, is less than expected to arise from the business. It's like when Dangote come forward and say, it's normal, Dangote would make, like, I'm just assuming figures, so 500 billion revenue. Somebody that is making 500 billion revenue you now came out in one particular year and say, we made 200 billion. What happened? FIS will be like, there's something wrong somewhere. And no problem. Because they made 200 billion instead of their usual 500 plus, the FIS will not tax them on their turnover instead of taxing them on their taxable profits. They will not tax them, and the percentage is not fixed. They can use any percentage. That's what the word fair and reasonable percentage. So they can say 15%, they can say 10%, they can say 5%. Then the third condition is where the true amount of acceptable profits cannot be determined. It means that you don't even know how much your acceptable profits, maybe because the company is not keeping an adequate record. If the company is not keeping an adequate record, how would they know whether they even have profits or they don't have profits? And since you decide not to keep adequate record, the tax authority will tax you on your turnover using a particular percentage. Use their discretion. They will be the one to use their discretion and say, okay, according to the size of this company, I think 5% is good. I think 10% is good, right? So that's it. Those are the three circumstances in which you use the gross turnover basis. The implication of the above provision is that whatever is obtained by applying a fair and reasonable percentage to the company's revenue is deemed its accessible profit for the assessment year concerned. You guys guess? So whatever you get is the accessible profit, and on that accessible profit, you now apply tax. You apply your tax rate, 30% or 20% if it's a medium company. I hope you got it. So now the last basis, we have dividend basis. Dividend basis, where dividend is paid on profits on which no tax payable is due to no accessible profits, or accessible profits is less than dividend paid. The company paying the dividend shall be charged to income tax at the appropriate rate on the dividend paid or proposed, as if it were its total profit for the assessment year. Now, let's break it down. A company comes forward and says that they paid dividend to their shareholder, but the tax authority went to check this particular company's financial statement. They see that, number one, they don't have any taxable profits. You don't have taxable profits and you pay dividend. Where did you see money from? Do you get that kind of scenario? Where did you get the money that you pay people when you do not have profits that you want to pay tax on? In that case, they will not say that, okay, no problem, but yeah, pay your 30% on the dividend that you have paid to people. Do you get? Sometimes when the dividend is paid on profits that is not taxable too, they can also do that. So now people are not saying that when this particular basis, people were complaining that it's very bad because dividend could have been paid out of retained earnings. And remember, retained earnings has been previously taxed in the previous assessment year. I don't know if you get. Retained earnings is profit from the previous year that has been kept by the business and not distributed to shareholders. If we kept the profit from last year and decided that, okay, this year that we did not make profit, it's profit from last year that we want to distribute to our shareholders, you cannot come and tax profit that you already taxed last year again. Because of that, the Finance Act 2019 now decided to exclude some dividend from the treatment of this dividend basis. So these are the dividend that they exclude. Let's take them one by one. Dividend paid out of retained earnings of a company, provided that the dividend are paid out of profits that have been subjected to Company Income Tax, Petroleum Industry Act, or Capital Gains Tax Act. It's just like the example that I gave, right? The dividend was paid out of retained earnings, and that retained earnings have suffered tax before. So if you now tax that dividend again, it's like you are taxing the same profits 2 times in 2 different assessment periods. Number 2, dividend paid out of tax-exempt income pursuant to the Capital Gains Tax Act, Petroleum Industry Act, and Industrial Development Act or any other legislation. Not before we are saying that if it's tax exempt, even if the income is tax exempt, that you pay dividend from, they still tax it. But now, after 2019 Finance Act, they are saying that if it's from tax exempt income, you're not supposed to tax it again because the income is tax exempt. All franked investment income is not supposed to be taxed. So if the dividend paid out is frank investment income, you cannot use dividend basis to tax or to charge CIT for that particular company. So now distribution made by REC is real estate investment company, to its shareholders from rental or dividend income received on behalf of those shareholders. So now this real estate investment company, what they basically do is what? Collect money from different people, use their money to invest in real estate, and when they get money from that real estate, they distribute the profits, the money from that real estate to those what? To those people that have bought their shares. Now, this one is their job, their main business is to do what? Invest, get dividend, and what? Redistribute. So now for this kind of company now, you cannot say you want to be taxing their dividend because they will always distribute dividend. They will always distribute dividend, right? It should be noted that exemption still applies, whether or not the profit generated such dividend are put in a year other than the year in which dividend was paid. What we are saying is like the retained earnings one. So for retained earnings, the dividend was generated in the year before. So even if they got the profits last year and they decide to distribute the dividend this year for REIT plans or for this real estate investment, so it does not matter that it is not this year's profit that they are distributing. Cocoa is that it is REIT, dividend from REIT. So no charging of taxable rates on it. Are we good with dividend basis? So that's it. So those are the four methods of what? Computing company income tax. Let's talk about withholding tax, and I think we can see solve one example. I'll look for one small simple one that we can solve. Then
Sorry, ma, I have a question.
okay. Ooh. Oh yeah, who is asking question? Is it Wilfred? You can ask your question.
My question is that in the situation where the company decided to issue a dividend to shareholders, but the dividend is not in cash form, they decided to issue out shares in respect of cash. Maybe they did not generate enough cash, because I know it's when you have cash, when you have enough money that you share dividend, but they decided to show, like, to give something to their shareholders in form of shares. So in that situation, what tax authority is going to, how is it going to be applied, the tax?
Okay, thank you for that question. You know, this particular dividend basis is based on profits of the company, money that goes out. So in that your own scenario now, no money went out now. No money came into the business and no money went out. They simply just increased the number of shareholdings for their what shareholders. They're talking about bonus shares, right? That's bonus shares. It's not even right issue. For right issue, at least they are going to pay money.
Okay.
So that's like bonus shares, I mean bonus dividend, what do they call it? So when you pay dividends using shares, the company did not earn any money, they did not receive money, neither did the shareholder receive money, they only receive shares. Do you get? So in that case, you cannot use dividend basis.
Oh, sorry, man. Because if you see it like in this situation, it's like is the tax authority they are losing in this situation. The company, maybe they might have make profit, but decided not to pay dividend in cash because of maybe the tax authority will collect their own percent. So they decided to issue shares, because we see that for the individual, the shareholders, they did not lose anything in as much as they did not receive cash, but they received shares, and their capital, let me say, their number of shares increased. So
Okay.
it's like the benefit to the shareholders and the benefit to the tax to the company. Meanwhile, the tax authorities, they are losing in this situation. So what are they
They're
going to?
actually not losing. You just don't really understand how it works. For that kind of profit, they made a profit. They did not distribute it. It's like you have a net profit. Out of the net profit, you retained everything. You do not distribute any profit out of the net profit. You decide to retain all the profit for the business and distributed bonus dividend instead of what? Instead of the normal cash dividend that you are supposed to distribute. That retained profit will be taxed 30%. That is the normal basis. That means you are going to be taxed using the normal basis. That your net profit that you decide not to share will be taxed. So if you now say that you still want to this dividend, remember that dividend basis is used on certain condition, right? If the company meets those conditions, even after they have paid cash dividend, they will tax them on the dividend. If they don't meet those conditions, right, then they will use normal basis or other basis to tax them. Regardless of what the company is doing, they will pay tax. If they share the dividend and they fall under dividend basis, they will tax them on dividend. If they don't fall under dividend basis, they will tax them on the retained earnings that they made for that particular year. I hope you understand me.
Yes, ma'am. Yes, I get it.
So that's how it works. So, all right. So withholding tax, despite the exemption of profit of small companies from tax, a company doing business with a small company is expected to deduct withholding tax from relevant payments due to the company and remit same to FIRS. The small company may request for the refund of withholding tax suffered. Now, let me explain this. We have not done withholding tax, and that should be our next topic after CIT by God's grace. So, this withholding tax is like an advance payment of company income tax. An advance payment of company. It's not a type of tax, actually. It's just an advance payment of company income tax. And it's just like the name connotes. You are withholding money from people. I'm supposed to pay you 25K. I paid you 23,000. It's usually 10% for company share. Do you get? I'll remove 10% and pay you 90%. And that 10% that I remove is not from you. I have to remit it to the what? To the government. So we're not saying that small companies that don't pay tax income, if I want to pay small company money, because I know that small company does not pay company income tax, will I still remove withholding tax from them? Yes. You remove withholding tax. That small company can now go and what request for a refund that I'm not supposed to pay tax, so and they have removed advanced tax, which is withholding tax for my what money. So I'm requesting for what a refund from the tax authority. That's just what this one is about. You might not really understand it until you get to withholding tax, since we have not done withholding tax. I just decided to put it there for professional guys because I'm using this material for them as well. All right, guys, let me check the question that is not too long and can easily understand. I think this one is okay. Number one is good. Let me see number two. Number two is not too long. Okay, let's see what we can do. Let's see what we can do. We can do the two of them before we leave. Then I'll take assignments. Okay, please, are you guys reading the written aspect of these things? Those chapter 1, chapter 2, and so on. The written aspect, please read it to because we might not have time to go to all those preliminary written aspects. Introduction to tax administration, rules and relationship, chapter 1, 2, 3, 4, 5, 6, 7, 8. Read it, please. I beg in the name of God. Chapter 1 to 8. Read it. I think all other ones will be covered by reading. Okay. All right. So Aderogba, let me open an Excel sheet for company income tax. Aderogba Nigeria Limited is owned by Nigerians and has been in business since 2022, since the year 2022. The result of the company as at 31st December 2024 as follows. We have the asset employed, non-current assets, current assets, less liability. Let's go. Financed by. We are provided with the following additional information. Revenue of the company during the year was 240 million naira. Please, what are they trying to tell us with this information? Can anybody tell me? What are they trying to tell us with this information? They told us that the revenue of the statement
They
that
are trying to tell us the turnover of a 200.
the turnover, yes. What of what relevance is this information? God bless you.
To know whether it's a million.
God bless. The company is not a small company, so the company will be subjected to what? Tax. Please, do you guys get what I'm trying to say? So the revenue was given for you to know that this company is not a small company. So now the gross profit was 35 million. Accessible profit was 2.1. They even get accessible profit. On relief capital allowance brought forward from 2020 year of assessment. I guess that would be a mistake. It's supposed to be 2020. What's it called? 2024 year of assessment was 300,000. Capital allowance for 2025 year of assessment amounted to 800,000. We are required to, number one, compute the company's minimum tax liability for 2025 year of assessment. Number two, compute the company income tax liability for 2025 year of assessment. Guys, can we try to do A? Can we try A? Minimum tax. We discussed minimum tax. Let me help you by writing the formula out. 0.5% of gross turnover less franked investment income. It's okay if you guys don't know it. No, we have not done any example. So it's okay if you guys don't know it. I just want to see which of you can try to get it based on what you have said before. I hope some people are attempting the thing. Do we have any answer?
Go up again.
Eh?
Go
I
up,
should
go
scroll
up
up, okay.
for the question. Yes.
How far? 1 minute is gone. Let me give 1 more minute. Okay, guys. Okay. So now let's do it together. Or did anyone state the answer? Let me come and see. 175,000. Thank you, Wilfred, for trying. Let's see if you are correct. Now, the formula for minimum tax, let's go and write it in our Excel so we can find it easy to trace if you want to go back to the solution of the questions. What's the name of the company? Aderogba, right? Aderogba Limited. The first question says, compute what? Minimum tax. And minimum tax equals to 0.5% of what? Gross turnover less franked investment income. Franked investment income is what? FII. Abi? So now, we know we are using 0.5%. That one is a given. We know we are using it. But the question is, what is our gross turnover? And do we have any franked investment income? Let's go back to the question and see. We have revenue, we have gross profits, we have accessible profits. Abi? All of these things, where is our gross turnover? If you go back to this table, do we have anything gross turnover there? No. But if I can go back to the definition of gross turnover under minimum tax, we are saying it is just like the sales of the business. Sales of the business. So in this question, our gross turnover is nothing but the revenue of the company. So let me bring forward my calculator. The gross turnover is revenue of the company. So there's no frank investment income because they don't tell us about any dividend paid by the company or anything. So now let's enter. So minimum tax in this regard then is equals to 0.5% multiplied by, how much is it? 240 million. Multiplied by 240 million. And we have, that will be 0.5%. Percent will be 0.5 divided by 100 multiplied by 240. 1.2 million. Oh, if they are not right, 1,200,000. But thank you for trying. If can you tell me how you got your figure? Okay.
I do it.
But at least you tried. At least you attempted it, and that's very, very important, because even in your exam, if you're not sure, shall write it. If you're not sure, shall write. See, the funny thing is that thing that you're not sure about might be the correct answer. Honestly, you don't know. It might be the correct answer. So even if you are saying, I'm not sure, as long as you don't have any other thing to write, put it there. Write it there. Are we good? Okay, so now that's the minimum tax done. Let's move to the second question, and it says that compute the what? company income tax for the 2025 year of assessment. Now, where are we going, Seth? Accessible profit, yes. But no, on the normal basis that I gave you, we started from what? The profit as per account. But here we don't even know what the profit per account is. The finance buy did not give us net profit. It only gave us what? Reserve. And reserve, it includes profit from previous years. This gross profit cannot be used. Why? It is gross and not net. But they gave us something that has simplified things for us. They gave us what? Accessible profits. So now let's go back to remember that I told you that everything is important, right? So this is where number 2 is going to be. Number 2. So now we start with the name of the company. Ade Rogba Limited. Computation of company income tax for 2025 year of assessment. For 2025 year of assessment. Yes. So we have mirror sign. Let's put 1 here. Let's put another here. Okay. So we're going to be starting with what? Accessible profit. And what is our accessible profit? Accessible profit is 2.1 million naira. 2,100,000. Let's put this one in something. Now, after accessible profit, let me go back to our Kine so you can see it. After accessible profit, what is next? Loss relief. Abi? After loss relief, you go to capital allowance. Don't forget to. Accessible profit is what you get after you have done all the adjustments, blah, blah, blah. Though, I'll not lie, according to my knowledge, is, how can I say it? Well, because we used to argue then, what is the difference between adjusted profit and accessible profit, right? Some will say it's the same thing. Some will say that is after loss relief or something like that, but we stick with this, right? Accessible profit. So now we go. Is there any loss in the question? No. No loss. Where is it? Yes, no loss. But what do we have? We have capital allowance. We have capital allowance. So we're moving to what? Capital allowance. So you can just do this. So we have balance brought forward. Balance brought forward. This thing is too far. Let me delete one column. And wash it. That's better. Balance brought forward. How much is the capital allowance that was brought forward from previous year? That's 300,000. 300,000. 300,000 for the year. Capital allowance for the year is what? 800,000. 800,000. So what is the total capital allowance that we have? Total capital allowance is this. Now, we want to know the capital allowance that we want to absorb. So we first have to do the restriction. And restriction is what? 2/3 multiplied by 2,100,000. So if we calculate this, what do we have? 2/3 multiplied by 2,100,000. 1.4 million. It means that 1.4 million is higher. Let me write it. Equal to will disappear. So that is equals 1.4 million. So it means that we are not restricting now. So capital allowance relieved is going to be this total capital allowance. This one will be in brackets. This one will also be equal to what we have relieved here. So then it means that we are not going to have any capital allowance carried forward. Capital allowance carried down because to 0. Now, for this one, we are going to be having our taxable profits. Did I put it? Yes. So taxable profit equals to this particular figure. This is our taxable profit or total profit, or I think that's all the name that they used to call it. So tax liability now. Let me see what the question says. Is it tax? It says company income tax liability. So CIT equals to 30% of taxable profit. So which is equal to, that should be 300,000. How much? Let me go and calculate it. So let me go with you. 30% is 0.3 multiplied by 1 million. Oh, and I was correct actually. Okay. 300,000. Now, we want to check if you compare with minimum tax. Compared with the minimum tax, the company. Let's go and check before I write nonsense. How many years has the company been in existence?
Please, can you zoom your Excel sheet?
Why is something? Yeah. Lobby one. You see, it's not zooming. Okay, sorry, I did not click into it. Can you see it better now?
Yes, ma'am. Yes. Thank you.
Okay. Akara. Yes. So the company now, I was checking the number of years. The company has been in business since 2022, and this is 2024 statement. So 2022, 2023, 2024, that's 3 years. The company cannot pay minimum tax. So what I'm about to write, it does not apply. So this is the company income tax. The company will not pay minimum tax. It's still a new business, but it's no longer a small business. So this is what the company will pay as minimum tax. Assuming this question has said compute tax liability. No, the question specifically says company income tax liability. They didn't say tax liability. If it were tax liability, you have to compute what? Tertiary education. You have to compute it. Do you get? And according to what 3% of acceptable profits, that's 2,100,000. Do you get? But let me delete it so we'll not get confused. This company, the question says income, company income tax specifically. That's why we stop there. So let me see this one. Should we take the second example? Can you guys still assimilate the second example?
Sorry, ma. How did you get the 2/3?
That's the rule, though. No, the rule says, I'll explain to you that. Let me write it out. Restriction of capital allowance to 66.2/3% of what? Of accessible profits. 66.2/3% is the same thing as 2/3. Do you get it? So instead of writing 66.2/3%, which most people will not even know how to write in their calculator, write 2/3 straight. Do you get?
Yes,
Thank you, man. This is confuse me. Thank you.
Okay.
My hands are
Okay, sister Uche, you can speak. So sorry.
okay. I wanted to know, when are we going to, is it that, when do we know that we will apply this restriction? How do we know we apply it? Like, is it when you are not giving is it when we cannot work for allowable and disallowable expenses that will recognize that restriction?
For capital allowance, right?
For CIT, I don't know.
Okay, so for the minimum tax.
No, I'm talking of the restriction. How, when do we know that we'll recognize it? What are the
Which
criteria?
restriction exactly?
This 2/3.
The 2/3 is for capital allowance. It's not for company income tax now. We use it for capital allowance.
Oh, okay.
And you should always compute it to compare with capital allowance to know whether you are relieving the restricted amount or the total capital allowance amount.
Oh, okay.
You should always do it.
Okay. Thank you.
Hello, ma'am.
Yes.
Just a quick one. Sorry to draw us back. Assuming the 1.4 that we have is how do I put it now? Because what we have here is 1.4, and the one that was brought forward is 1.5. Then what do we do? Are we going to look for 2/3 of the 1.5?
Let's try to copy your analysis out.
Okay.
So we copy this. Let's paste here. Okay. So now you are saying that this, let's assume for the year, is
yes, ma'am.
You said 1.5. I mean, we're adding, if this one is 500,000.
Yes, ma'am.
And this one is 1 million.
Yes.
Can you see what happened? Now, this is the amount of restriction is lower. What we are going to relieve is no longer 1.1, but what? The restricted figure. We will not carry 100,000 to the following year. So it means that in the following year, this balance brought forward year is going to be 100,000.
Okay. So the 100,000 will be carried forward to the next year.
Yes.
Okay. Okay. Thank you.
You're welcome. Any other question? So, guys, I'll be giving you an assignment. Chidima, ask your question. You can unmute and ask.
I think have asked. I need to put down my hand. I was the one that asked about that restriction 2/3 that I didn't understand.
Who else is raising up? You can put down your hand then so I can see the person's name. Glory, you have a question. Glory, you can unmute.
Okay, I wanted to ask about, because the restriction was 1,400, but you didn't use it. So that was my main concern. That why didn't you use it?
The what?
The restriction of 1,400. That's why you calculated it. And then
The
you now like
1,400. Yes, because it's bigger than the actual capital allowance.
Okay, so there is after and there is restricted. So we have to
This
choose the
this
lower
is the
one.
actual. We are picking the lower. In this example now, the restricted is lower. We use the restricted.
Okay.
Are we
Okay,
good?
sorry, ma. Okay, so is the lower of the restriction and the calculated one we will pick?
Yes,
Okay.
yes.
Hmm.
I think we are good, right? So assignment. If you guys don't do my assignments, we'll fight too. I don't like when people don't attend to my assignments. Glory, you want to ask a question? Glory, I can hear you. You want to ask a question? This one is going to be too much for you guys. Okay, I think other ones are kind of complex. Just do number 2. And you guys have do number 2 and number this under this exercise number 3. There's what's it called? Under the practice question, do number 3. Under the illustration, try number 2. Okay, try number 2. So we meet in the next class. Next class will be our final class for company income tax. So come with all your questions.
Okay.
Can we
Yeah.
screenshot the question?
Then what about the listen? How do we get the material written,
Two
this
people are
thing?
talking at the same time. Oh. You said
I was thinking that how can I screenshot the question? You didn't leave it for a while, so we can screenshot it and do it.
go and pay for your material. Stop screenshotting questions.
Now, is the material available? Because I've paid for the material. Is it already there?
Everything is. I'll say like immediately we end this class. I'll go and upload it now.
Okay, because I've paid for the material already. Thank you.
I'll go and upload this now and the Excel too. Okay. I guess that is the end of class. Please try to do your assignment. I'll see you guys next week Friday. Bye.